certainly supports a fundamentally constructive view. So if you kind of break down what the core fundamentals are, which are earnings and valuations, earnings are coming through. Second quarter reporting season is about a quarter of the way through, and so far beats are outpacing misses. You have about 3% positive median surprise, and we're on track for about 17% earnings growth for the full year, and we think second quarter will be roughly around those levels, flattered upward by the recovery in semiconductor sector in Korea and Taiwan. But even if you strip those guys out, you've got about 9% core profit growth. So that's kind of your underlying core dynamic, and then you got valuation. And valuation, of course, is influenced by interest rates, which is your question. So the market's now pricing a bit over 2 cuts this year by the Fed, September and December. That is our Goldman Sachs economics view. In fact, market's pricing a bit more. If that happens, that will open the door for central banks in Asia to lower their rates, their policy rates. And when you get lower policy rates, that's generally good for stock markets as long as growth is holding up. So if the earnings come through, as I just mentioned, and you get a bit of easing or accommodation on the valuation front, then that's a fairly constructive backdrop.
Conviction calls in this region?
Yeah, so look, our bottom line is we're fundamentally constructive on a kind of a 12-month view because we've got earnings deliveries we were talking about before. Valuations have come back to what we think is fair value for the region, somewhat cheap for Japan, which went from over 15 times to 14.1 as of a couple of days ago. China and Korea are cheap. India and Taiwan a bit more expensive, but look at the region as a whole. We're trading at 13 times earnings, bang on what we think the macro environment should be. So we think that overall return should be roughly in line with underlying earnings growth, which is called around 10%. So we've got a constructive view. That being said, in the short term, we're running into more adverse seasonality, August, September, October. We've got the run-up to the U.S. election. The market might price some volatility around that, given uncertainty. So we've been expecting kind of a bumpy late summer, early third quarter, and then rally in the back end of the year against a kind of an overall constructive view going forward. We're overweight Japan. We're overweight Korea. We certainly like the semiconductor and the tech sector.
India?
India, we're overweight, although that might take a bit of a pause because maybe a bit over its skis valuation-wise. And structurally, we prefer China A to offshore China for a bunch of reasons we don't have time to get into. But that's kind of where we are right now.
Gotcha.